If you think tax savings is just about finding more deductions, that mindset is probably costing you money. And honestly, this is one of the biggest mistakes I see business owners make because they think if they can just write off a few more meals, a few more miles, maybe buy one more thing before year end, then somehow that equals strategy. It doesn't. That is not tax strategy. That is reaction. And there is a massive difference between the two. If you are a business owner and you have ever felt like your taxes still seem too high, even though your CPA found deductions, this video is for you. Because I want to show you why deductions by themselves are not enough, what real tax planning actually looks like, and how to start thinking about tax savings like a strategic business owner instead of somebody just hoping to catch a few extra write-offs. Here's the truth. A deduction is a tool. It is not the plan. And too many business owners have been taught to confuse the two. They think tax savings means what can I buy? What can I expense? What can I write off? And that is about as deep as the conversation goes. Listen, I get why, because that is what most people have been told. Most business owners have been trained to think about taxes in a very narrow way. They think tax planning happens in March or April, or when the CPA sends over a checklist. And if the checklist includes deductions, they feel like, okay, great, I guess we're doing tax strategy. But what's really happening a lot of the time is your CPA is looking backward. They're saying, here's what already happened. Here's what you spent. Here's what we can categorize. Here's what we can deduct. And while yes, that matters, that is still not the same thing as a strategy. That's cleanup. That's after the fact sorting. That's not the same as sitting down early enough to influence the outcome. And that distinction matters a lot more than most people realize, because when you only focus on deductions, you're staying in a reactive posture. You're asking, what can I write off after the money has already been made and after the year has already unfolded? A real tax strategy asks a very different question. It asks, what decisions can I make now that change what happens later? That is a completely different mindset. And honestly, it is the mindset shift that separates business owners who keep more of their money from business owners who are constantly shocked by their tax bill. I see this all the time. A business owner has a pretty good year, profit is up, revenue is up, they are excited. Then tax season rolls around and they are frustrated because they still owe a big chunk to the IRS. And usually somewhere in that conversation, they will say something like, but we had so many deductions. I thought we were writing everything off. Or my CPA said we got all the deductions we could. And maybe that is true. Maybe they did get all the deductions they could get. That still does not mean they had a strategy. Let me say that again because it is important. Getting deductions is not proof that you had a tax plan. It just means somebody counted what already happened. And that is where people get tripped up, because deductions feel tangible, they feel immediate, they feel easy to understand. You spend money in the business, you deduct the expense, your taxable income goes down. That part is real. But the problem is a lot of business owners stop there. They never zoom out and ask whether the deduction itself was smart. They never ask whether the structure of the business is right. They never ask whether the timing of income matters. They never ask whether there are retirement strategies, entity strategies, family strategies, or accountability plan strategies, health-related strategies, real estate strategies, or even industry-specific strategies that would say far more than another random write-off ever could. And that is where the money gets left on the table, because sometimes the biggest tax savings do not come from finding another deduction. They come from changing the framework entirely. For example, let's say you have a business owner who makes really good money and they are still operating under the wrong business structure. They are so focused on deductions that every year they are trying to squeeze more write-offs out of the same setup. Meanwhile, the bigger issue is the structure itself. So they are chasing a few $1,000s in deductions while missing tens of thousands because the entity is not aligned properly. That happens all the time. Or let's say a business owner buys equipment in December because somebody told them, go buy something before year end so you can write it off. And I just want to pause there because this is one of those things that sounds smart, but sometimes it is not. Because if you are buying something you do not actually need just to get a deduction, you are still spending money. You are not magically coming out ahead just because it is deductible. A deduction lowers taxable income. It does not mean the government paid for the whole thing. And this is where people get sideways. If they spend $10,000 to save maybe $3,000 or $4,000 in tax, depending on their bracket, and then act like they won. No, you still spent $10,000. And this is why I say a deduction is a tool, not a strategy. A strategic decision might be buying equipment you were already going to need, timing it properly, and coordinating that with the overall tax picture of the business. That is different. That is thoughtful. That is planned. That is not the same as panic buying in December because someone said you need more deductions. And honestly, some of the worst tax decisions get made in panic mode. That end of year scramble where people start asking, what can I buy? What can I spend? What can I write off? What can I do really fast? That is usually a sign there was not enough proactive planning earlier, because the best tax strategies are often not rushed. they are considered, they are layered, they are implemented intentionally, and they start way before year end. That is the part a lot of people miss. Real tax strategy is proactive. It is not just looking for deductions after the fact. It is looking at the whole picture ahead of time, reviewing your income, your entity, and your payroll. What about your family, your investments? Did you optimize your retirement planning? How does all of this fit with your goals, your growth plans, and your exit plans, even your cash flow? Because a tax strategy that saves money on paper but crushes your cash flow may not actually be a good strategy for you right now. And this is why real tax planning is so much more nuanced than just write-offs. Here's the bottom line. A deduction is not a strategy. It is one piece of the puzzle. Useful, absolutely. But is it enough on its own? No, definitely not. Real tax savings comes from proactive planning, and it comes from looking at timing, structure, and strategy throughout the year. It comes from asking bigger questions than just what can I write off? And it comes from recognizing that tax prep and tax planning are not the same thing. If this video made something click for you, or if you have ever realized after the fact that you were thinking way too small when it came to taxes, I would love to hear from you in the comments. What is one tax lesson you learned the hard way as a business owner? And if you found this helpful, make sure you subscribe, because this is exactly the kind of conversation I want to keep having here. Not fear-based tax talk, not dry accounting lectures, real strategy that helps you keep more of what you earn. And if you want to keep going on this topic, I'd recommend watching my video on the difference between a tax preparer and a tax strategist, because that really is the next layer to this conversation, and it will help you understand why so many business owners feel like something is missing even when their taxes are technically getting done.